Cool. Hi. Right. So let's get on to capital gains and sort of plow through. So these are the basic general rules before we start looking at special cases, and let's go through this. All right. Great. So here we're talking about capital gains for the individual. That's the first key thing. Or when I say for the individual, really, we're not dealing with there is a focus on the individual, the sole trader. We are talking about companies as well, in terms of companies being chargeable persons. But you'll see what I mean by what we mean by the individual. So typically, things that you receive and then you sell off to make some money on is what we're really dealing with here. This is really happening here in terms of chargeable disposals. The reason they tell us chargeable disposals is because, for example, if someone out of the death estate is giving out something that isn't charged based on chargeable gains tax, no, that's based on inheritance tax. But of course, the person who receives it, if they sell it on later on, then they may be chargeable. To chargeable gains. So the key point here is just distinguishing, which is what they do here very quickly, with this idea of what are chargeable disposals. Pretty much selling, and we will come to this idea of when you have a good that's destroyed and you receive insurance funds for it. And we are very much dealing with the market value, so it's not really about whether or not it was gifted to you for nothing, or whether you paid nothing for it or you paid a part sum. The key point here is what's the market value less the original cost. And chargeable people or chargeable persons, companies as well as individuals. Remember, we've just been working on corporation tax, and those chargeable gains are charged at corporation tax rates. Of course, people if you're in the UK, everything you own worldwide is subject to chargeable gains tax, but non-UK residents will only pay corporate chargeable gains tax on disposals in the UK. But we don't need to learn it. The key point is we just need to be aware that all your gains abroad are subject to chargeable gains. Right, so let's jump in. So typically we have certain exempt assets. I mean, in class, I remember highlighting there's certain things we don't care about. So, for example, we'll come to these chapters. Chapter 21, I guess it's only just fair your HMRC will allow you to have at least your own home, if you like. But that's subject to certain rules as well. You must literally live in the thing, and you are deemed. You do have some exemptions if you're away. We'll discuss that in chapter 21. Cars, no one is interested. So this is really important. No one is interested in any of the events going on with the cars. So you can, vintage cars, in the past this was an issue, but no one's interested with cars, nothing at all. So these are totally exempt. And qualifying corporate bonds as well, totally exempt. Certificates, totally exempt. Prizes, anything happening through ISAs, totally exempt. And we'll come to this idea of wasting chattel when we look at chapter 19 and non-wasting chattel. So these are special cases. But typically, most things are, and we'll see that. So typically land, buildings, investment properties, paintings, antiques, things like that. We'll come to all of that. Now, I mean, it is pretty straight. When I say pretty straight, I'm trying to calculate the thing. So this is, which is why I was highlighting this idea of the individual. So typically, you will sell the thing, whatever it is. Let's just say it's a painting or an investment property or whatever it is. And you are allowed, of course, to deduct selling costs. So you can actually get the net disposal proceeds. And then, of course, all the capital costs that have, when I say capital, of course, this is enhancement costs that have gone towards bringing this asset to its current place for you to sell it, if you like, will end up being, if you like, yes, a chargeable gain, or of course, or an allowable loss. Right. So again, like I say, the disposal is typically, consideration is typically the proceeds. But if it was gifted to you, or if there was some internal business going on, it must be then the market value will be substituted for the actual proceeds in order to arrive at the actual selling price. Again, like we've said, you can deduct all the necessary costs during the selling of it. So typically auctioneer fees, estate agent fees, and that sort of thing. Right, so let's see an example. This is kind of highlighting what we've talked about. If it was received as a gift, we're really looking at the market value. And if it was inherited, of course, this is what I was saying earlier on, you might inherit something. So the probate value, or the market value of the date of death given to you. So, but typically you buy something and then you sell it. But if not, if it's gifted to you, it's what is the market value probate at date of death? And then we then sell it. And then we have incidental costs of acquisition, all of these. So let's look at this question very quickly, just to kind of just get a balance of what we're talking about here. Yes, and typically this is the normal case in reality. Betsy, which is why I was saying we're dealing with the individual. Betsy will sell an asset for 25,000. So proceeds. She sold the thing for 25 grand, and she incurred auctioneer fees of 2 grand. So in effect, this is a selling cost, isn't it? Giving her 23 grand. And then, but what happened was she had bought the thing for purchase costs 7,500, paid legal fees of 250. That takes her to 7,750. So we can see here that legal fees on acquisition, if you remember from just general accounting, is capitalized as a capital expense. And so this minus this brings us to, let me just get my calculator out. 25,000 minus 23,000 minus 7,750 takes us to 15 to 50. Oops, 15 to 50, 15,250. That's the gain, chargeable gain. And then, of course, we'll again, because I think this chapter focuses a bit more on individuals, we'll talk about what exemptions he's allowed from these in a second. Cool, great. So that's the chargeable gain. Really important to remember the difference between the chargeable gain and the taxable gain. Chargeable gain is occurring pre-allowance. So, right. So we have a capital loss. Of course, this will occur, of course, if the costs, if the allowable costs exceed the net proceeds. Right. So let's look at this example here to see what they're getting at here. So Janet sells an investment property on the 2nd of February. Sale proceeds 500,000, and she got this in May when the market value was 100,000. So that's the initial probate, if you like, probate amount. So initial, I just changed my pen color. Initial cost 100,000. There we are. And an extension was built June 87. And if this is an extension, this increases the value, doesn't it, of the property, 30,000. So that comes to 130,000. It says here she spends 2,000 repairing the roof. This is repairs. So we have here 130, giving us a net figure 370. Right, brilliant. So we have that. So that's the gain. If you like, that's the gain on sale. What we also see here is this. He says she sold a painting, which was she sold a painting for 8 grand, and it was given to her by her mother. The cost of the date was 15 grand. So she's made a net loss of 7,000. Right. So now the thing here, I think we discussed this in class, is that investment properties have a different band rate. So it's at 18% and at 28%. So 18% for the basic rate payers and 28% for the higher rate and additional rate taxpayers, as opposed to all the other assets where it is 10% and then 20%, 10% for, and we'll see this literally in the next slide, 10% for the basic and 20% for higher and additional. So it's important to not mix the two together, to keep them separate and then analyze it that way. But this question just wants the net chargeable gains on each of these. So that's 370 here, and a gain here, and a £7,000 loss here. Okay, great. And so again, the reason why I said this chapter seemed to focus a bit more on the individual was just because here they talk about the annual exemption allowance for the individual, and you allowed 11,700 each year. And those are your gains there, and then you have that. So you have whatever it is, deduct that, and the balance. Put charge at the higher slice of your income. So we will come to your, we will look at your band and see whatever's left. We'll do a question in a second, and then we'll put those in there to deal with. So current year capital losses are set off against current year chargeable gains to the maximum point that may lead to AEAs being wasted. So in your year, you would use up all your capital loss will wipe out any capital gain. But if you remember, we did this if you personal tax. Capital losses brought forward can be preserved, can be brought forward to offset any future gain. So you can kind of bring forward any capital loss if you have one, to offset any gain. So you can still use your 11,700 in that year, right? So we'll see some questions I'm saying in a second, but let's see. This is an example of the usage, forgive me, of that loss. So here we have this business that has made, that's got a gain in shares of $2,000. It has this is quite a straightforward one actually, and a gold necklace of 12,500 and a loss of 6,500. So just add these two together and take this away, and you're there. This is what 14,500 minus 6,500. 14 minus 6 is 8. So $8,000 is the net taxable gain over there, right? And that's just that one. This is this business we were talking about, restricting the losses. Let's look at this one, right? And that will probably bring us up to 15 minutes. So what we have here is that we have a scenario where these people have in 1819, they have a gain, platinum ring, they have a gain of 12,600. They have a loss of 500. You do all of that. That takes you to 12,100. Just change my pen color. So I'm carrying forward losses of $6,000, but I need to just use enough of a loss to make sure I still have enough to use against my annual exemption. So I will only bring forward 400 and continue to carry 5,600 forwards, if you like, right? So then that's the picture. So you have here. That comes to nil, and then I have this. I'm able to carry this forward. So therefore, preserving the annual exemption as opposed to wasting it. But if this had been, for example, I don't know, 8,500, you would have had to use all of that loss in that year, and then that would just have you would just have had to carry forward the rest of the 6,000 based on that, right? Cool. Well, let's see. No, I think what I'll do is, yes, I'll leave this. I'll start this. We'll start talking about the rates in the next video and apply it to the questions as we do the next video. Cool, great stuff.